Hi, class. Welcome to Chapter 13, where we're going to be talking about equity valuation. This is a great chapter. It'll help put a lot of concepts into practice. I also plan on showing you a variety of charts from actual stocks at this current point in time, things I think, look attractive here and why. And we'll go from there. So let me pivot to the PowerPoint slides. Great, equity valuation, as I said, chapter 13. So in terms of equity valuation, book value, that's the net worth of all the common equity according to a firm's balance sheet. Limitations of book value. So what does book value really mean? So net worth of all the equity according to a firm's balance sheet. What is equity? It's what's there for the owners, right? When you have the assets minus the liabilities, what's left is equity. Limitations of book value, liquidation value, net amount that would be realized by selling the assets of the firm and paying off debt. Sometimes if you had to sell everything, you wouldn't get what you have on the balance sheet because it would be effectively a fire sale. Replacement cost. Sometimes the book value can be have limitations because the cost to replace the firm's assets could be much higher or much lower depending on the environment. Then the Tobin's Q, which is the ratio of the firm's market value to its replacement cost. Meaning, if you had to rebuild everything, what is that versus its market value? So sometimes the market value in the effectively book value can differ. Remember from accounting that a lot of the assets on your balance sheet have to be held at cost and are not upwardly adjusted. So one thing you would look at here, and here's a good thought for you guys, something to put in your pocket when you think about equity valuation. You want to sound smart at an investment cocktail party. Most home builders, when they get to a trading range of 2 times book value, that's considered expensive as a rule of thumb. I won't go into the details onto why that is. It's a common measure of how expensive something would be for home builders. Each industry, and sector can have different metrics that can at times be more effective in determining whether something's cheap or expensive. Now, there are some home builders out there that are trading at more than 2 times book value, and people are still buying them. And the reason why they're still buying them is that the case they're making is that because the home prices in rural areas have increased so rapidly that the book value is irrelevant to home builders. The metric is no longer stable because there's been such a quick appreciation. Where typically in a normal home market, you'd expect home prices to rise a few percent a year. So hopefully that gives you some context. I can pivot. I'll show you guys something actually here on another screen. What I mean by this, and I'm going to pull this up here in 1 second for you guys. So if you look here, this is a stock that we've discussed before. This is LGI Homes. LGI Homes is trading at 2.7 times book value. Its 5-year high for this valuation metric is 3.9. 5-year low is a 1, and the average is 2.4. So it's trading about its average range, but its average range, and you can see that here versus industry, it's typically a little bit higher. For a comparison, another home builder is called Toll Brothers, not to be confused with the cookies. It's the home builder. We can compare their valuation metric right here. Price to book value is 1.2. So that looks at face value to be cheaper than LGI Homes. Another metric I look at is the PEG ratio here. It's price to earnings divided by growth. And then we see that for Toll Brothers to be about 0.9. Going back to LGI Homes, And hopefully this is some good practical thinking for you guys about how I look at the market. LGI Homes has that same PEG ratio of 0.9, but they have a higher price to book value. The reason, I believe, for some of the valuation disparity, so it's saying adjusted for growth, they're providing a similar, risk and return profile, but in another metric, price to book, LGI Homes looks a little bit more expensive. The rationale for that is that LGI Homes focuses on only homes an hour outside of cities, and that gives them a particular advantage. If you end up being right, it's because your thesis of them, being cheap because their business is so good justified the higher valuation. Well, if you're wrong, it's because the story didn't play out, right? Maybe people move back into cities pretty quickly. We'll pivot back to the slide. Actually, I'll show you one more chart here, and then we'll go back. And this is another chart I'll use for valuation. Again, this is LGI Homes, a name we've discussed before. Up top here, the blue line is the stock price. The green line up top is the 50-day moving average. It's the average of the 50-day price. And then the purple is the 200-day average. And that's just a measure of reasonability. If something has gotten really expensive, it will move outside of its moving average. And also, if the 50-day drops below the 200-day, that's usually a bullish signal, right? And you can see that when it happens, the 50-day is below the 200. That typically, has been a good entry point, typically. The other metric here that we'd notice is the second one down. That's price to earnings. Price to earnings, it looks cheap, only trading at 9 times earnings. Next, you'll also notice that it has short interest, which we haven't gotten into, but people who are negative on the stock are at 10%. That's pretty high. And then next we have the PEG ratio, which adjusts the price to earnings for growth expectations. Anything below 1 appears to be very cheap. So, I'll also be talking today about stocks that I think look inexpensive. Again, this is not a recommendation for you to buy these stocks. Things can appear expensive, cheap, and turn out to be expensive, and other stocks can appear expensive and turn out to be cheap, depending on how the story changes. So back to the slides. This is just financial highlights from Microsoft saying, in 2014, it had a price to earnings ratio of 18 against the industry, price to book of a 4. Now, remember I said price to book for home builders is a 2. It would be expensive. For software companies, it's completely different. So something else to consider. PEG ratio, 2.6. Let's look back at Microsoft. Let's make this a fun exercise and go back to the stock of Microsoft here and see how, and basically reference some of the story here with Microsoft. So going back right here, we're going to check out Microsoft and their charts. We're going to go out a little bit longer. Let's go 10 years in time so we can see the 2014. Oh, didn't like that. So let me go back here. Ten-year chart now for Microsoft. We see here in 2014 that price to earnings ratio of 14, 15-ish, eventually trading up towards 17. And we see as the stock got cheaper, so did the price to earnings again in 2015. But this low valuation kind of that floated between 14 and 18, turned out to be an indicator that the stock was cheap, because you can see that actually by the tilt of the chart that Microsoft started rising at a faster rate than its valuation. You also see short interest. This is actually bullish, right? Because people appeared to be negative on Microsoft and became less negative. And then next, you also can see here that the PEG ratio varied wildly. One thing I'll mention about the PEG ratio is that the PEG ratio has some assumptions. The only thing that's known is the price of the stock. Price divided by earnings. There's two types of price to earnings ratios, and it's always important to dive deeper to figure out which one they're using. And it's either the last 12 months of earnings or it's the expected next 12 months of earnings. So always ask which price to earnings they're using. Is it the expected 12 or the historical 12? The historical 12 is more factually accurate, but it doesn't incorporate future growth as quickly, because if you're growing fast, you're using last year's numbers. And then also the G in the PEG ratio equation here at the bottom would indicate the average investor's growth expectations, which can end up being wrong, right? And that's how you can be right. One thing I'd say about Microsoft right now, it looks pretty fairly priced at about a 2 with the PEG ratio. Price to earnings at 30 seems high, but they are still have pretty stable patterns of growth. So anyway, going back to the slides. Expecting holding period return. So how much do you expect to make on the investment? That's a function of the dividends plus the increase in share price. Really simple math formula from that perspective. What'd you buy it for? What income did this investment kick off to you? And then what do you sell it for? Right? And that's effectively your return. So some investments you might own because they give a lot of dividends. So they give you a lot of income. Like think about like a rental apartment, right? That's going to kick off a lot of income. But then there's other assets you buy because you believe the price is just going to go up. Next, intrinsic value. That's the present value of the firm's expected future net cash flows, discounted at a required rate of return. So again, these are great academic functions. But the present value, which you discount, let's say you say we're going to make 100 grand a year, and let's discount it at 3%. So like, what would you pay, for that cash flow if you had to value $100,000 a year from now is probably worth $97,000 today if you discount it at 3%. But sometimes your predictions of what expected future cash flows are going to be could be different. You could be conservative, or you could end up being aggressive, or you could be spot on. But getting that right and the discounting right are also two areas where people get it wrong. Market cap. So market cap consensus estimate of appropriate discount rate for firms' cash flows. So how would you discount the company's cash flows? That's another way to increase the risk for that company. So if a firm is you view as more risky, one thing you can offset that risk in terms of valuation is you increase the required rate of return or the market cap rate. Increasing those will give a bigger discount to those cash flows. Basically, you're saying you have less certainty, right? So it's giving a bigger discount to those future cash flows. Dividend discount model. I'm skipping the other two because intrinsic value and holding period return we just talked about. That's the formula for the intrinsic value of a firm equal to the present value of all the expected dividends. There are some stocks don't pay dividends. So, and there's no perfect valuation model. But for a stock like this, I should say, for a stock like General Mills or CVS that pay north of a 3% dividend, and you expect that dividend to pay for the next 20 years, let me do the math right here. We'll do a little fun dividend discount model on my calculator. So we'll say it's 3.5% times, let's see, 70. So we'll say that owning CVS will pay you $2.45 a year. Let's say you own it for 20 years. What are you going to give the discount rate on CVS? I don't know, 2%, right? It's not that risky, CVS. So the present value would say that that would indicate that it has a future value of $59. It's trading at 70 right now. So that might say, well, it's overvalued. Well, one thing I would consider is like, well, what if the dividends go up? Am I pricing in the possibility that they pay a bigger dividend? So if I make that dividend from $2.50 to $2.75, just increasing that, that says the stock's worth about $67. So trying to figure out a fair value based on the dividend can be an interesting exercise. I think because CVS has the ability to distribute the vaccine and consistently stay open, I think they have the ability to rapidly grow earnings. And again, this revisits what I was just talking about. The constant dividend model, assuming dividends grow at a constant rate. And you might have that dividend. So let's say dividend 1, we'll do this formula. See, the dividend of CVS is $2.45. And K is the market cap rate, the risk-free rate, right? And I can look at what CVS actually, on my other tool here, how much they've grown their dividend in the last 5 years. And let me look this up, guys. Over the last 5 years, CVS has grown their dividend at 11%. So let's just assume 11% they grow their dividend. So if they're paying a dividend of $2.45, and we assume a risk-free rate or a market cap discount at the 2%, that means the 0.2 minus the 0.11 for 0.09. Assuming this grows in perpetuity 11%, which would be high. Let me see. I think I got my math wrong here. Apologies, guys, for the moment of silence here. What I'm getting here for the constant dividend discount rate for CVS is actually closer to $30. So, that would indicate that, again, CVS is overvalued here. So implies a stock's value is greater if there's a larger dividend, lower market cap rate, and higher expected growth rate of dividends. For a stock with the market price intrinsic value expecting holding period, you can actually discount each individual cash flow. If you predict a cash flow for each year, you can actually, let's say you expect them to be higher than lower than higher, you can discount each one of those cash flows for each period. So if you were discounting 1 year out, it would be 100 divided by 1.03 for discounting at 3% 1 year out. If you want to discount $100 2 years out at 3%, it's 100 divided by 1.03 to the power of 2. And that's how you compound for the second year. Third year cash flow is 1.03 to the power of 3, so on and so forth. Stock prices and investment opportunities. So dividend payout ratio is pretty important. One thing I would tell you about the dividend payout ratio as it's relevant to today would be the stock of something like Exxon. Exxon is paying a dividend north of 10%, and they're paying a dividend higher than they can afford to pay out. So they're basically taking on debt to maintain their dividend because what will happen is if they cancel their dividend or reduce it, the stock price will also decline. So they're trying to support their stock price by paying a dividend they can't afford in the hopes that in the future, the fortune reverses itself and they'll be able to maintain that payout ratio. Plowback ratio to earnings retention ratio, that's the proportion of the firm's earnings reinvested in the business. So how much is the company paying out to investors? Because all the dividend is usually it's supposed to be what is paid out to investors in the form of net profits. And then the remainder is what's paid back into the firm. Usually if you have a high growth firm, these high growth firms don't pay out to investors because they know reinvesting in themselves is going to be the fastest rate of growth. Next, present value of growth opportunities. So again, another present value calculation. The hard part about present value calculations is, can you determine the speed of their growth? Life cycle and multi-stage growth models. So you can have a two-stage dividend discount model where you have the company growing at one rate for one period of time, and then it grows at a faster rate for another period of time. Consider the following information. The firm's dividends are expected to grow at 20% for 3 years. At the start of year 4, it goes down to 25%. The stock just paid a dividend of $1. Assume the market cap rate of the stock is 12%. So what it's saying here is that if you take these cash flows, right, growing at 20% for 3 years, and you're discounting them at 12% each year, and then in the final year, in what's called, the terminal year, because this last formula here at the bottom right, that formula represents what growth looks like in perpetuity. So what you're doing is you're calculating the next 3 years, as you're seeing in the second line from the bottom, and then you're calculating what the growth rate is going to be in perpetuity. So you look here and you see that in the terminal value, it has a 20% cubed, but then in the future it grows at just the 1.5%. And then and then on the denominator, you're getting that 12% for the 3 years for the K, the market cap rate, and then you're also subtracting it by the long-term growth and multiplying it by that first number. And that's going to get you the two-stage dividend discount model. Effectively, you're present valuing two different models. Price to earnings and growth opportunities. So price to earnings multiple is a ratio of the price of the stock to the earnings per share. It's one of the most common valuation metrics. So it's the price today, and again, this metric they're giving us, it says E1. So what they're telling us there is that they're giving us the forward PE, which is expected earnings, which can always be wrong, right? If you were doing price, when can that be wrong? If you were like the CEO of Dave & Buster's and you had a reasonable PE ratio, well, guess what? You didn't anticipate the pandemic, so your projections of earnings 1 year out from now are way off. So that's just another thing to consider here. It's also, if you're confident that the company will grow its earnings at a fast rate and they'll grow to a bigger place than they are at today, you'll pay a higher ratio than something that the market believes will not be persistent. So one area that I'm positive on at the moment here in December of 2020 is home building and things associated with home building. They appear to be cheap, and I think they're very cheap because I think housing is in such tight supply that you're going to continue to see it grow, especially outside of cities. PE ratio for a firm growing at a long-run sustainable pace. So this can be calculated by 1 minus B over the cap rate times return on equity multiplied by beta. You will rarely ever see that in the real world. In the real world, you're going to see like the price of the stock divided by its forward earnings expectations. And those usually aggregated by Wall Street estimates. Next, the PEG ratio. That's a ratio I like to use because it normalizes stocks that might have a high growth rate. So you could see a high PE stock, and then you're like, oh, that looks expensive. But then when you look at what the growth expectations are, then the stock can then appear cheap because you're like, well, if it grows at this pace, then it's actually not expensive at all. So it's important to look at a stock through multiple lenses. And again, this is just an interesting chart showing the effective ROE on growth and the PE ratio. So if you can grow your earnings quickly, you can probably increase your cash flow quickly and then increase your dividend faster than the market expects. Why will a stock go up in value as it relates to dividends? Sometimes a stock can issue a special dividend, make a one-time payout. Scott's Miracle-Gro did that earlier this year. So Scott's Miracle-Gro, a good example of someone that beat expectations and the stock immediately started going higher on the now future expected higher dividend payout ratio. All else being equal, riskier stocks have lower PE multiples, higher required return on, and higher required RORs. Why? Well, because they appear cheap. One of the riskiest stocks in the market is called Micron. And they make memory chips, and they look consistently cheap. And another stock that looks cheap, or did look cheap for a while, was General Electric. And this is just another example of stocks that look cheap and then stay and continue to be cheaper, right? So again, just something to be mindful of, that a low PE. Stocks that have a low PE right now. Give you an example. Something I mentioned in my market update was Sportsman's Warehouse. Sportsman's Warehouse, they sell like outdoor goods and stuff, right? You can see, which is really interesting, as a stock got more expensive in terms of its price, its PE went down. Why did that happen? Well, basically the stock is going up because they're performing well, but their earnings are even better than the stock performance. And what that's telling me is the market doesn't believe that they'll be able to sustain this for a long period of time. The market is saying like, hey, they did really well, but to be honest, we don't expect this increase in demand to be that long. So, remains to be seen. I will say that it has a decent amount of short interest, which means that it could be volatile when you see short interest being, higher than a few percent. Additionally, PEG ratio of less than 1 looks very attractive, but it's also a small stock, so it's risky, right? So this is a $600 million company, not some major firm. Back to the slides. PE ratio with inflation. So one thing I'll mention too is I think the better ratio here to look at is PE ratio with interest rates. When there's a lower interest rate environment, likely that justifies a higher PE multiple in the market. So stocks look expensive historically right now. This is a huge debate academically in the investment world, is that the high market PE, and what do I mean by the market PE? I mean, just like look at the S&P 500, and I'll switch back to these that graph again. So if you look at the S&P 500, as it loads up, when we increased interest rates in 2018, the market kind of lagged, and also the price to earnings ratio started to go down, right? Why did that happen? It's because the higher interest rate means you're discounting earnings at a higher rate. But when you have lower interest rates, you're discounting at a lower rate, justifying a higher PE multiple. So we saw the PE multiple, not only did the market get more expensive, but the multiple got more expensive too. The best scenario, in my view, is when the stock goes up and the PE goes down at the same time. And you have to have really good earnings and the price to lag that. So, again, something to consider. Back to the slides again. Pitfalls in PE analysis. The practice of using flexibility in accounting rules to improve apparent profitability of a firm. So it won't catch if a firm is being fraudulent or manipulating data. There's a lot of discretion. So if you're doing price to earnings, which is expected future earnings, what if you're wrong? What if your expectations are wrong? Then your analysis will be wrong. Right? Earnings growth for two companies. So this is FedEx versus a utility company. Not surprising, utility company isn't much of a growth industry, right? Because they just pump out electricity. But FedEx is doing logistics and shipping. What's happened between 1996 and today? The launch of the internet, e-commerce. The amount of packages you get today is way higher than it was, even 5 years ago. This is price to earnings ratios for Con Ed and Intel. So you see that Con Ed is pretty stable. Again, electricity versus Intel, very cyclical. Big highs, low lows, right? Times are great and times are tough. But with electricity, you're buying it no matter what. PE ratios, this is a great example of how different industries can have different ratios that, so when you don't want to compare, a construction firm to a pharmaceutical firm because their valuations are typically very different. So you can see that software firms typically have high PE ratios because they have the ability to grow quickly. Meanwhile, airlines, right, have low PE ratios. Why? Because airlines are subject to big booms and big busts, right? For a different reason, telecom stocks have a low PE ratio, but that's because they're giving you stable returns, right? Anyway, we'll continue on. Combining PE analysis and discounted dividend model, it's just different lenses to view the same stock. Some things will look expensive under one lens and cheap under another. Price to book can see how aggressive the firm market values itself. Price to cash flow is less affected by accounting because it's just cash. And price to sales might be the only metric you can use for a startup. If you're looking at a company that has no profits yet, price to sales is the only metric you can really use in order to see, what's effective. Again, here's some valuation ratios for the S&P 500. You can see here in 1999 is expensive by every measure. Free cash flow for firm. So that's a way of looking at free cash flow. So if a current firm has cash flow, maybe not profits, you might want to value the firm via the cash flow method. You can also use free cash flow to equity holders. Again, this is not a common measure that I use. It is helpful for investors, though, looking at stocks with dividends, because if your firm has heavy cash flows, it usually has the ability to pay dividends or increase them. So one way to make money in the market is if you can maybe predict firms that might increase their dividend. So you can look at firms that are already paying a dividend that have increasing cash flows. And then, estimating the terminal value using the constant growth model. Again, these are a lot of hypotheticals. I don't chug these formulas out too often here. They're more academic, but free cash flow over weighted average cost of capital is another formula. And this is just really at the end of the day, I see these formulas and what is it showing me? This is another discounting formula where you're discounting future flows of cash that are happening at some point in the future. And right here, It's talking about what's the firm worth if they have that much in cash and stock and that much of debt and this much in shares. What's the value of that firm? What's the value of the equity? We can skip this slide. And this is another one showing free cash flow to equity is 900,000 for years 1 through 4, and then is expected to grow at 3%. The market value of equity going through that, again, another discounting mechanism here, right? You're discounting at that that market cap rate. If there are 500 shares outstanding, what is the predicted stock price? Why can debt be ignored? Because why is debt ignored in this model? It's because it assumes that this is all net of debt, right? And that assumes that because you have cash flows, you have the ability to pay your debt in advance of this. So comparing valuation models, they can differ in practice, as I mentioned. There's different underlying assumptions. Again, if a firm doesn't pay a dividend and has a high PE, I like to use a PEG ratio. If it's a home builder, I like price to book typically, right? There's other tools I might use that I think are good measures of where a company is going, and oftentimes they're an indicator for me to look deeper, right? Something might look cheap, something might look controversial, but you have to figure out why. Investors, like myself, employ a hierarchy of valuation techniques. Looking at, so you'll pay more for a growth firm than you will for a firm that's not growing. Then you can also, besides from the individual stock, what about the aggregate market? So, you can also apply a lot of these same techniques to the dividend discount model to the stock market as a whole as well. Earnings yield to the S&P 500 versus treasuries. So what it's saying right here is because treasuries are trading at let me tell you what treasuries are trading at today. Loading up, guys. Sorry. Still loading. The U.S. Treasury is trading at 0.94, but you can get a dividend in the S&P 500 at about 1.7. So, that might indicate that the U.S. investor is still better off pouring money into the stock market compared to bonds because the yield on those bonds is so low. So that might be a bullish indicator for the stock market. And, we'll end that here. I hope this class was interesting for you guys today. Please don't hesitate to leave comments, ask questions. Always happy to answer them, and looking forward to speaking with you soon.